Welcome back. Fourth quarter earnings season has been a bit of a mixed bag so far. Some companies are trying to cope with a slowdown in consumer spending. That's one factor that has our guest wary of a few big Canadian names. Let's bring in Noah Solomon. He's Chief Investment Officer at Outcome Metric Asset Management. Noah, thanks a lot for coming by.
Thanks for having me.
What is your take thus far on earnings season, both here in Canada and the U.S.?
I think there haven't been any large surprises on either side of the border. To your point, going forward, and this is really more of a Canadian thing for a couple reasons, I would be wary of the consumer. And that starts off with the issue that Canadian households are, arguably the most indebted in the world. And as I understand it, you can either eat your cake all at once, or you can eat it bite by bite over time. So Canadians have been eating a lot of cake very quickly in the form of debt, and there has to be some drag on consumption going forward. So from an investment perspective, I would be wary first and foremost of the direct connection. So, companies that are exposed to the Canadian consumer like Aritzia, Canadian Tire, I would be wary of those names. I think earnings growth will be challenged simply because there's payback for Canadian households. And in a more tangential way, I would be a little bit cautious on the banks. I don't think there's going to be massive defaults or a disaster, but I think earnings growth will be somewhat challenged because they are maybe not as directly, but exposed to the Canadian consumer. I think loan growth, whether it's mortgages or consumer loans or credit cards, will be anemic going forward because consumers are already full on debt, and loan growth is a big part of their profit growth. So I think their profit growth will be somewhat anemic.
On the banks, there's a bank in the U.S. that's in trouble, New York Community Bank. Commercial real estate lending is a factor. And Peter Rutledge, the superintendent of financial institutions, spoke on it yesterday. He's actually looked at the regulatory filings of that New York bank. His job, of course, is to look forward to the Canadian banks and risks facing them. His view is the Canadian banks will get through their exposure to commercial real estate and U.S. commercial real estate fine without any major profit hits. He thinks profit may be muted in some cases, but it is not going to be a wipeout for the Canadian banks. Do you share that view?
I do. I think that's exactly right. I think, number one, if you just look at Canadian banks' exposure to U.S. commercial real estate as a percentage of their balance sheet, it's infinitesimal compared to the regional bank you mentioned. So right away, it's sort of a very small part of the overall. And second of all, in a more aggregate sense, the way Canadian banks are regulated and the capital buffers they have to maintain are, as we've learned time and time again, not least of which during the global financial crisis, have a lot of buffer and are very safe. So whereas it might be a disaster for a regional U.S. bank, it's probably nothing more than a speeding ticket, which might have a small effect on profit growth for the Canadian banks.
Bloomberg News, as we mentioned this morning on this story, reporting an expert at S&P Global Ratings saying that the most exposure that the likes of CIBC, Bank of Montreal, Royal Bank, and TD Bank have to U.S. commercial real estate is between 1% and 2% of total lending. Let's go back to Aritzia and Canadian Tire. Why do you single those two out when you are cautious on the Canadian consumer?
Well, those are direct links to the Canadian consumer. It's arguably those are a couple companies with the most direct links. They don't have large U.S. operations. Most of their sales go to Canadian consumers and Canadian households, as opposed to, let's say, Canada Goose, where it derives a huge proportion of its sales and revenues from all over the world. So they're sort of directly in the crosshairs of that Canadian consumer needing to pull back because of huge debt levels to begin with, not least of which a lot of them are going to start getting reset at much higher mortgage rates.
Couple stocks you do like, and these companies also are exposed to the Canadian consumer, BCE and TELUS, two of the big three telco companies.
So Canadians, I agree. Canadian stocks in general, the TSX has a yield of about 3.2, a dividend yield of about 3.2%, which is more than double the S&P 500. So dividend yields compete when people want income with bond yields. So As bond yields come down, which they have been, and it is anticipated on both sides of the border they will continue to be, Canadian stocks, which are very dividend heavy in general, look good because those dividends look better and better relative to bonds. In cases like BCE and TELUS, you're talking about some very stable blue chip companies that have dividend yields between 6 and 7.5%. And for Canadian investors, that dividend has a preferential tax treatment, so that's very attractive. My guess is those kind of dividend yields won't hang around for long.
I.e. the share prices are moving higher, you predict?
Absolutely.
Okay, and we remind viewers always that BCE is the parent of this television channel through its Bell Media division. You like utilities as well, Hydro One, Emera, and Fortis.
Basically for the same reasons. These are very stable companies with good coverage. They are not yielding as high as the telcos, arguably they're even more stable because they're regulated, but they have yields of around 4.5%, 5%. Now, when you figure out the difference in tax, that's like a bond equivalent yield of 6%. So that's very attractive, and to the same point, that can't last for long.
Gold prices are historically high. They appear to have plateaued, at least for the time being, at about $2,050 US dollars per ounce. You like Agnico Eagle Mines, one of Canada's big gold producers.
So I like gold in general, not because I have a view on gold per se. I like gold in general because gold stocks as a group are the only group of stocks, the only sector, if you will, or subsector, that have no correlation to other stocks. So they are a true diversifier. They're the true joker in your deck. It's not clear you give up return by owning gold stocks versus something else, but they are an excellent diversifier. So in that sense, they represent a free lunch. In today's world, given that you have what's going on in Russia, Ukraine, the Middle East is a tinderbox, tensions between Taiwan and China, I generally think having a little bit of that joker in your deck, gold stocks, is a good thing at any time. Today, I think it's particularly important given geopolitical tensions, which could, go from a tinderbox to an eruption at any point in time. There's just too many things out there as opposed to one that could all erupt at any time. So I like having that. Companies like Agnico within gold stocks I like because they do pay a dividend. They have been steadily increasing their dividend. So within that world, they're the most stable animals.